All right, so here's Tuesday and Wednesday's opening range gap. I'd like to keep opening range gaps on my chart for 3 days. After 3 days, it expires in my mind, okay? And it's all part of my Power 3 concept. It's not just simply the open, high, low, and close, or the accumulation, manipulation, to distribution. It's not just that. It's much more than AMD. Tuesday, Wednesday, opening range gap is shaded here. Notice that from Tuesday crossing over to Wednesday's opening range gap, it was still being respected on Thursday. Look at the respect of it here. Look at this candle's high. Look at the bodies in here. See that? The buy side is what I told you we would reach out for right up above here, and that we would trade up into the high end of that gap. We opened up here, traded down at 6 o'clock, and then we meandered around and then found our way up to it and above it, fell short of the buy side liquidity here. So the objective is what? Still run no stops. So it comes all the way back down to the low of that opening range gap from Tuesday and Wednesday. So this is what happened on Tuesday, and we have one here also, okay? So I'm going to add this one. I'm going to change this one to a different color. It'll still be on the chart because it's very important you understand what's about to happen here. It's shaded in gray. So we have the opening range gap for Wednesday, Thursday now, which is this now broader range. So there's an overlapping of those two opening range gaps. After we get this opening range gap here, the old one, Tuesday, Wednesday, we open above it, trade down, and find support at the lows of it. You see that? But it didn't fill this. Why? Why didn't it fill that? Because it has unfinished business. Where's that unfinished business? The buy stops up here. Ran up there, hit it. Now we have a gap. Just like we were treating yesterday's Tuesday, Wednesday opening gap, we had some portion still to fill in. Now we can look for this area here to potentially have a event fill it in tomorrow or reprice to it. And that's my expectation going forward. I think that we're going to try to make an attempt to get down here and work towards this area here. That's what I think. Okay. If I'm wrong, it would need to go back above current new week opening gap high for me to be bullish again. So now we have both of those gaps. We have Tuesday, Wednesday opening range gap, and we have the Wednesday, Thursday opening range gap. And we're back down here on electronic trading hours. So you can see there's relative equal highs. That's where I think it's going to draw to and get to the top of that old Tuesday, Wednesday opening range gap. Well, we did that here. Then we fell short. Notice what we did? We went above the range high there, but we didn't get to the buy side yet. Then it dropped all the way down to the low of that gap. See it? Followed along. You still see it in here, and then boom, it's gathering all kinds of new orders, but not by itself. Look closer. What is this? It's a fair value gap at the lows. So smart money is accumulating right in here. Market rallies up, comes back down, one more tap, and then takes off, trades into a buy side imbalance, sell side inefficiency, which is a fair value gap, and order block right there. Where's the target? Wham! Hits it beautifully. Does it continuously keep going higher? No. It rejects it, comes back down into the range, buy side, rallies one more time, pumps in, and then fails once more. So I'm watching to see if this potential phantom trend line here breaks. And if it does, we'll be looking for the sell side here, below here, and into the gap that would be otherwise expected to normally fill. But again, it's a holiday weekend. Anything can happen, folks. The volume will be different than it normally is. There's a lot of people that simply are going to go away. All right, so now we're on that 5-minute chart, and we're ringing in the new day opening gap. Good grief, ICT. How many gaps are you going to talk about? All the ones that matter. Okay. So the new day opening gap, we have the closing price at 5 o'clock, and then we have the opening price at 6 o'clock. So that hour separation is what we're showing here. That's your Wednesday, Thursday, new day opening gap. Extend that throughout the day. You can see how we get consequent encroachment of it here and then sells off. Then we fall just short of hitting the top of it here. We work outside of it and then rally one more time. Notice that in this little area right here, we're hitting an order block, but we're also in consequent encroachment of the low and the high. Remember that gray shaded? That's the Tuesday, Wednesday opening range gap. That range here, split that in half. That's consequent encroachment. That's what you're seeing right there. Order block, consequent encroachment of Tuesday, Wednesday opening range gap, rallies, small little gap in here, trades down into the low end of the new day opening gap for Wednesday, Thursday. That's this one over here. So what's so specific about this here and this here? It's occurring around that 8:30 news embargo. So we had news that come out, and then we have the impulsive price leg that runs up, retracement, runs again. It falls short of our objective, then crashes all the way back down into an order block here. And it's also the low of what? That Tuesday, Wednesday opening range gap low. It's lining up right with that order block, digging into it, and then rallies one more time, and then finally blows out the buy side that I told you last night would be the objective for today's trading for Thursday, May 25th, 2023 for ES. We slipped lower, consequent encroachment of new day opening gap. That's this gray area. Rally one more time to run into the rejection block, which is the highest up close candle here. All right, so now we're going to get into some order flow. And this is going to be a little bit in depth, and just bear with me because this is probably going to be one of those videos at this point you want to come back to at a later time. Come back to this one a couple times this year. Like every 3 weeks, come back to this one, and you'll see that you understand more about what I'm talking about here every time you do it. All right, so we have the 10 o'clock to 11 o'clock silver bullet hour in the AM session. This is ES on a 1 minute chart. And you can see at the high end of that old opening range gap, we're opening and then slamming down. Remember, we fell short of the buy side liquidity I told you we were going to go for. So we went outside the range of the opening range gap, and then right here, we slam lower, trade down into an order block. Remember the order block I showed you before we went into the slide here? Let me go back up. That's this one here, okay? The blue line is that order block right there on a 5 minute chart. On a 1 minute chart, that level right in here, what we're studying is the 10 o'clock to 11 o'clock time. And give me one more time, go back up to that. 10 o'clock to 11 o'clock, we're looking at this price action here. What's being shown on the 5 minute chart here, we're zooming into all this little area here on a 1 minute chart right here. Now all this, we're going to magnify it and looking at it on a 1 minute chart. So we're in that same area here. So the market drops down, we create a fair value gap in the form of a SIBI, sell side imbalance, buy side inefficiency. That's this move here. We create relative equal highs and relative equal lows. It trades down. Remember that shaded area here? This is the low of the old opening range gap, Tuesday to Wednesday, and Tuesday to Wednesday's opening range gap high. We're trading at the low of that old Tuesday, Wednesday opening range gap. Hitting it here, hitting it here. Look at the bodies respecting it. We just go outside of here, and then we run these relative equal lows there. The wicks are doing all the damage. Then we quickly run back up, take out a short-term high. Now we have something right. This is the 2022 model. Take stops, shift in market structure, fair value gap, buy it. That's your silver bullet. Ooh, so I can blend the 2022 model and the idea of the ICT silver bullet, blend it together, and this is what you do. It isn't always going to be a continuation. You're going to treat it sometimes with a reversal, and this is what you're looking for here. You can buy it here. These arrows are just for illustrative purposes. These are not executions for disclosure's sake. I'm just showing you where your entry would be. This is how you want to do your own journaling. But there's two opportunities here for the silver bullet. You have this one here where it trades down into it, and then we have this one here, and it rallies up, takes the buy side here, and then runs into the bearish order block, and it doesn't even need to trade outside of that old range on Wednesday, Thursday's opening range gap. So we have profitability and being incorrect. Remember, we're aiming for the buy side. Wait a minute, you just said we're wrong and we can be profitable? Yes. Remember the rules for silver bullet. For ES or index futures, it's got to offer at least a 10 handle range. Well, if you're buying it down here at 41.42 and you're expecting it to go up to the buy side, that's the best case scenario. But you also have these gaps in here, this shaded area one here, and you have this one here. So you have Tuesday, Wednesday, and then Wednesday, Thursday's opening range gap. The algorithm will refer back to those same levels, folks, up to 3 days. Sometimes it'll refer to it beyond 3 days, but if you use 3 days as a general rule of thumb, it will serve you well. After 3 days, take it off your chart. Everything that I showed on the 1 minute chart, let me go back up and show you this again. Look right here. This is a 1 minute chart of the silver bullet here, and this is the silver bullet here on a 1 minute chart. Okay, a lot of overlapping in here, and then finally it leaves the range and it creates this fair value gap, and it trades down into it and it runs away. Let's go into this information a little bit more detailed, and also I want to look at all this imbalance here. Okay, why is it going up to here and stopping? Look right here. Here's your order block here. It went past that, beyond it. What's occurring in here? What is all that about? This is institutional order flow. Think about what I'm showing you here. Study this for a second. Pause the video, okay? Really pause the video. Study everything you see here and all this movement down and where these silver bullet entries are occurring and where price reaches up here. It doesn't look obvious here, but when you drop down to a 15-second chart, which I'm about to do now, so if you're not ready and you're still looking at it, don't play it. Keep it paused. Here's that sell side imbalance, buy side inefficiency. Okay, all this run down here and then into this low, we create those relative equal lows. We go down below it shallowly. That little shallow run tells me that any retracement higher is just going to be one more drive lower. And what does it do? It runs right back up to some random level, right? No, that fair value gap right there. See that? It's also a mitigation block, which is this down close candle. High, low, lower high. It's a reversal of sorts on my breaker pattern. A mitigation block is the down close candle in between the high and lower high. So it's trading up into that there and in an imbalance there, and then drives harder. So that's taking out the sell stops here. So it engineered it. It went low, low, created retail minded support. They're going to buy it. It rallies up. They feel rewarded, and then it comes back down. They may or may not have been stopped. It doesn't matter. Now, if they didn't have a stop, they're really going to put a stop loss there, right below those lows, in that low, in that low. And then you see it go wham, spends time down there trapping traders. Then it rallies, takes out a short-term high. That's a shift in market structure. Look closer. Inside of that shaded area on a 1 minute chart is a fair value gap, but you don't see that as a fair value gap here on a 15-second chart. So when we're in this institutional area here where orders would be resting, what kind of orders? Sell side liquidity. Then it rallies up and we have a shift in market structure. Wonderful, because I'm expecting that buy side liquidity, which is outside the scope of this chart here. Remember, it's above. That's where I think it's going to go. This 1 minute imbalance here that's shaded, it doesn't look like a fair value gap here. But what is overlapping on a 15-second chart that's still useful using what my PD array matrix taught you in the core content? 2 down closed candles is a bullish order block. Extend that to the right. We're digging down into that order block there, rallying and coming back down into it again. There's an order block and a fair value gap. That right there, if I didn't buy it on this pass here, I would see that and be going long. And I would buy it again here and adding more to it in pyramid. Same thing here with that silver bullet up here. This range is a 1 minute fair value gap. You can't see a fair value gap in here. You see this down closed candle though, don't you? So when it's trading down into that, that's where I'm going long. I'd be buying that order block right there. And then as it was dropping down, if it would have hit that again, that shaded area right on here, on the 15-second chart, I would add to it there. Look a little bit closer now. Look at this inefficiency. All of this movement down here, there's pockets where there is only one candle passing through. We have this small one in here. We have a small one right in here. All of this here, one candle passed through, one candle passed through here, and right in here. This one here is essentially repriced to right there. And it's rebalanced because it's left it here, here. So this was of no interest to me. This one gets filled in and repriced and balanced because it's back and forth inside of this area here. So now that's balanced. If we rally above that high, then we should have no problem going higher and not ever need to go back below that high. What I just said is huge, because everything over here is telling you the narrative that needs to be displayed in price delivery. Once we have this back and forth movement, that means it's efficiently been balanced. Once it leaves it, that means goes above it right there. It never needs to go back below this high. Does it? Not until it goes above and rebalances into this area here. This range here is this price formation. It reaches up into that, then pulls back lower. This range in here, it trades up into it here, finds support at it, and then rallies above. It does not need to go back below this high. It's acting as support, rallies up. You can see that area here. They work this level here back and forth. It's balanced once it leaves it. So then all I need to do is see it trade above it. That high right there gets traded above it, comes down, never sees it again until we get to this area here where this is inefficient and it's been rebalanced. This candle here trades down, then it opens, trades down, up, and leaves. That range is the only exposure for inefficiency because this candle went up, this candle went down, this candle opened, went higher, and then back down. So this range here and higher to that high it's balanced. The inefficiency is this candle right there. So that's why it only went right up to the tick. 2 candles and then plummeted down to new day opening gap low and then down into, which is a little bit to the left. I'm sorry, to the right of this. It's not in the scope of this fractal being shown, but it's the consequent encroachment of the Tuesday, Wednesday opening range gap. All right, here's a 1 minute chart on the E-mini S&P afternoon session between 2 o'clock and 3. This is your PM session silver bullet. Now here's where we've seen the price rally up. It did so during the 2 o'clock hour. It ran through it and then broke hard lower, leaving this inefficiency right there. The market trades up into it. That would be a short for a silver bullet because we hit our objective. We broke down and we could look for this inefficiency here, and it has a real gap. You see that? This, friends and neighbors, is a real liquidity void. That separation there is no price data being printed at all. No trades existed there. So when it did this inefficiency lower, it's a fair value gap, yes, but it's a SIBI. That means it's lacking what? Buy side. That means a candle or candles must go up in price delivery in that range. We see it return back to it here, and this would be a short, expecting it to go back down into this inefficiency and trade to that real liquidity void. It one more time pumps up into here, doesn't even get back up to the first silver bullet fair value gap, breaks again. There's a small little gap in here, and I would counsel you to take a look at this. And you might see this here and think, oh, this is one that would have been potential entry too, but would I enter there? No. Well, you got the benefit of hindsight. You can say that now. Look what it's done. It took sell side out here and then rally back up in. This is too close in proximity, so it could run above here to take out buy side and not get this high. So I would want to go into a lower time frame and look for something a little bit higher than this, or study and see if there's anything more in this area here as another fair value gap that may not be seen or visual in this 1 minute chart. The market breaks lower and does in fact trade back down into this inefficiency and rebalances price action right at that real liquidity void. Now, the question is, does it offer 10 handles or 10 points in range for potential high probability shorting? Because we've already hit our objective, the buy-sell liquidity pool, it hit that. And it hit it during the PM session, 2 o'clock on a Thursday. Thursdays can generally, not always, generally give you the opposite end of a range. Since we've been bullish all week, chances are we can create the high of the week in Thursday. Doesn't mean it will always, just many times it'll give you trades that are very short term and give you this type of movement here. We eventually try to go back up again, but it's enough to be paid on it, right? Right away, I'm reading your mind. I'm getting an impression now that you're thinking, why wouldn't you expect it to completely go all up here and close that in? Well, what did this run here do? It ran buy-side liquidity, and it did so energetically. And then we created this gap here. So this is a blow-off type move. It's kind of like capitulation. I'm not suggesting that we've made the high. I'm trading it and showing you with the expectation that we can treat it that way. And this is much like a breakaway gap. This gap should not completely close in. Notice that it came back up later on, but it didn't completely close it in. It left some portion of it open still right there. Everything I just showed you, now we're looking at on a 10-second chart. So here's that inefficiency. You can see it's one single candle here, and then your fill would be there. That was where you'd be filled, and this is the heat you took on it, or how much it would be losing against the open position short. You have an up close candle here. This is a bearish order block. The market trades lower. See this inefficiency? That did not exist on a 1 minute chart. This is the 1 minute fair value gap. After it took off below this low here, went down and then ripped higher back up into the order block. And look at the inefficiency here. See that? Went into it, touched the order block, traded sideways a little bit, broke down back into the high of the fair value gap, and then repriced lower. Then we started respecting that 1 minute fair value gap here, and then we left it. As we're trading down, I'm expecting, okay, I want to see how it trades there. It hits it, comes back up, fills in a little fair value gap. That's normal. Strong break lower. Okay, as it's breaking strong, I'm looking at this ghost image of the previous opening range gap. I want to see, does it dig into that? Yes, it does. And also, it digs into the new day opening gap. So all these levels I'm watching. I want to see it go a little bit more. I want to see a little bit more. Every time it reaches into one of these levels or another PD rate I may have interest in, I'm anticipating some measure of retracement. And if there's an inefficiency just formed, I'm expecting it to reach back up into that like it's doing here and then digging down deeper.